Hey guys, welcome back to the channel. This is Stocks with Ajay, and I just wanted to make a quick video about my portfolio. This is the first time I've done a video like this, but I do point to my public account on stockswithajay.com, and I've been thinking of making this video for a few weeks now. But I had some recent changes in the portfolio composition, so I thought I'd talk about what changes I made, the companies I'm keeping, my plans to going forward, and just to speak about each company and why I kept it in the portfolio for now and what changes may be happening in the future. So stick with me. As always, these videos take a long time and energy to make, so please like and subscribe. And with that, let's get into this portfolio. So this is what the portfolio looks like right now. As you can see, I've added significantly to my Warrior Met Coal position, and I've talked about Warrior Met Coal for many videos in the past, and also on some of my blog posts on Stocks with Ajay. And the thesis here is pretty simple. There's going to be a step up increase in free cash flow as their capex for Blue Creek winds down to a minimum to the standard ongoing long-term rate. In addition to the step down in capex, there's going to be a step up in production and scale. So I think they're going to start with around 4 million short tons of coal from Blue Creek in 2026 or 2027, and then they're going to ramp that up to ideal conditions, maybe over 6 million short tons, 6.6 million short tons of met coal. So with that production increase added on top of their current production levels, they're going to be reaching levels closer to AMR scale and production. And this is important in all industry dynamics and fundamentals, and industry nature, but especially when the coal prices start to ramp up, when steel demand increases, these coal producers are going to make a killing, and especially the higher scale producers will make a killing. So right now, Warrior Met Coal is at the end of the cash curve. They're so low cost cash. They're such a low cost producer. They're such a low cost producer that they can weather this storm, and that's why another reason that I chose Warrior Met Coal. But they're going to weather this storm until coal prices pick up because of demand from India and hopefully demand from other places in the world. And when they do that, they're going to have a 20%, 25% free cash flow to market cap value. And that is an insanely high number. So that's the base thesis for Warrior Met Coal, and I wanted to get in before they finish Blue Creek in 2026, mid 2026, and really start ramping up, and before any type of coal industry change happens to the upside. So that's a basic general thesis behind that. So also, you can see that I added to Google, specifically with Class C shares of Google, GOOG. And that was like one of the best decisions I've made so far. Clearly, Google has gone up. I think my average cost of the recent shares that I bought was close to maybe 150 something. Much lower than what it is right now. It can see that in the short term, it was a great decision, but I bought Google for the long term. All of these companies are long-term thesis anyways, multi-year plays. So I do believe that Google is still undervalued at 177. I think it can go maybe even double based on the buybacks, based on every single business segment they have, and other business segments that may not even be included in the price. For example, Waymo. For example, let's look at YouTube, that independently would easily be worth, I believe, 500 billion to $1 trillion. It has a bigger market share than Netflix, and Netflix intent is already close to $500 billion market cap. with aspirations to go to 1 trillion based on the recent news that broke out from their exec team. So there's no reason that YouTube, with a higher market cap, with a higher market share, wouldn't be that or more. So for various reasons, even more than that, they're leaders in quantum and AI and so many other things. So for all of those reasons, I think it's an easy buy. Even at this level, it's an easy buy. I think it's going to double in the next few years. Meta, I didn't really change anything in Meta, just because I think it's run up so much since I looked at it. When I was looking at it, it was closer to like $500 per share when in the recent dip in April. And I didn't add anything at the time because I was adding to, Warrior Met Coal and Alphabet. So I didn't really add anything there. I think it's going to do well in the coming years. I think their ads are going to keep getting better. Their ad revenue is going to keep getting better with AI integrations going forward. They're introducing their, they keep introducing their Llama models, increases in Llama model, and I think Meta is poised to do well. I haven't added anything to them just because they've run up so much, and I was allocating the capital that I had to Google and Warrior Met Coal. Right now, I'm not going to be adding any shares going forward, just because it's a little pricey right now for me personally. I think it's still going to double, maybe triple in the next 10 years. I just don't want to add anything right now. I would add something if it pulled back maybe 10%, 15%. I would do a few buys there. But right now I'm not adding anything. I'm just going to hold on to my shares. And then for Amazon, to wrap this up, the Amazon, I did add about 40 something shares, 43 shares. And I bought that when they reached like 170 something. And that was an amazing buy. As you can see, it's now $212, $213. So Amazon is really a powerhouse when it comes to everything. They have an amazing logistics and very complex logistics business. They handle their shipping for their e-commerce segment. They have AWS, which is their version of cloud, and they were one of the first to implement that in a very highly scalable and successful way. And you can see it in the numbers. They're generating billions of dollars with AWS every quarter and every year. Even though competition is rising with Microsoft and Google and others with their cloud provider providing services. And I think the major thing from an investor standpoint to understand about Amazon is that they reinvest nearly entirely all of their capital. That's what they do. Their business model is such that they open up a lemon stand here and they, build it, reinvest capital into that lemonade stand and make it produce top line revenues, high top line revenues, high bottom line revenues, make it efficient. And then instead of rewarding the shareholders that invested in the capital in the first place, they take that revenue and open up a cookie stand or something like that, and then they make that cookie stand, they raise it, so that the revenue is top line and the bottom line gets more and more efficient, and you get more top line revenue to the bottom line. And then instead of giving that to the shareholders in terms of like dividends or something like that, they move on to the next business. So that's Amazon's business model. They make something, they scale it up, they make it produce enormous amounts of money, and then they use that money to build up the next segment. So yeah, those are the updates for my public portfolio for June, and I seem to do a lot, but going forward I want to consolidate and concentrate my position so that I won't have to touch it much. And these are high conviction plays for me, so I can keep building on these shares and continue to grow. I've set a goal for about $500,000 in this public portfolio in the next few years, so I'm excited to track it with you guys, and all my subscribers can follow along the buys and sells that I do in this public portfolio, so we can hopefully all make money together. But yeah, so like I said in the beginning, like and subscribe to my content so you can get the most timely updates. And with that, I'll see you guys in the next one. See you guys.